The banking industry is one of the most critical sectors in any economy. Banks play a crucial role in the economic development of any country by providing various financial services to individuals, businesses, and government entities. However, throughout history, there have been instances of bank collapses that have had severe consequences for the economy. This paper will discuss the collapse of U.S. banks and the impact it had on the economy. So in this video, we are going to discuss U.S. banks collapse. The video is going to be amazing. Make sure to stick till the end. Now before we get into this video, make sure to hit that subscribe button and leave a comment below saying I subscribed. I will try my best to reply to as many comments as possible. The collapse of U.S. banks. The 2008 financial crisis is one of the most significant economic events in recent history. The crisis was triggered by the collapse of several large banks in the U.S. The subprime mortgage crisis, which began in the mid-2000s, was the primary cause of the collapse of the banks. The banks had been issuing loans to subprime borrowers, which eventually led to the collapse of the housing market. As a result, the value of the securities backed by these mortgages plummeted, leading to huge losses for the banks. The collapse of Lehman Brothers in September 2008 was a turning point in the financial crisis. Lehman Brothers was one of the largest investment banks in the U.S., and its collapse triggered a wave of panic in the financial markets. Investors lost confidence in the banking system, and banks began to fail one after the other. The U.S. government was forced to intervene to prevent the collapse of the banking system. The government provided bailouts to several large banks to keep them afloat. The bailouts were controversial, as many believed that they rewarded the banks for their reckless behavior. Impact on the economy. The collapse of the U.S. banks had a significant impact on the economy. The financial crisis led to a recession that lasted from December 2007 to June 2009, making it the longest recession since World War II. The recession had a severe impact on the job market, with millions of Americans losing their jobs. The unemployment rate reached a peak of 10% in October 2009, the highest level since 1983. The collapse of the banks also had a significant impact on the housing market. The housing market crashed and home prices plummeted. Many homeowners found themselves underwater, owing more on their mortgages than their homes were worth. This led to a wave of foreclosures, which further depressed home prices and led to a vicious cycle of declining demand. The collapse of the banks also had an impact on the global economy. The U.S. is the largest economy in the world, and the financial crisis had ripple effects that were felt around the world. Many countries experienced a recession as a result of the financial crisis, and the crisis also had a significant impact. The immediate impact of a bank collapse would be felt by depositors who may lose their savings. The Federal Deposit Insurance Corporation, FDIC, insures deposits up to $250,000 per account, but if multiple banks were to collapse, the FDIC may not have enough resources to cover all the losses. This would result in a loss of confidence in the banking system, leading to a run on banks and further exacerbating the problem. The government would have to step in to prevent a complete collapse of the banking system. The Federal Reserve would provide emergency funding to banks, and the government would likely pass legislation to ensure the stability of the banking system. This would include measures such as injecting capital into banks, restructuring debt, and potentially nationalizing banks. The savings and loan crisis. The savings and loan crisis occurred in the 1980s and 1990s and resulted in the collapse of more than 1,000 savings and loan institutions, also known as thrifts. These thrifts provided loans to individuals and businesses, but were heavily invested in real estate projects. When the real estate market collapsed, many of these thrifts failed, and the government had to step in and bail them out. The total cost of the bailout was estimated to be around $160 billion. The savings and loan crisis, also known as the S&L crisis, was a financial crisis that occurred in the United States during the 1980s and early 1990s. The crisis was primarily caused by a combination of factors, including changes in the regulatory environment, poor management practices, and risky investments by financial institutions. At the time, many savings and loan (S&L) institutions, also known as thrifts, were experiencing financial difficulties due to rising interest rates and inflation. To try and mitigate these issues, the government deregulated the industry, allowing thrifts to engage in riskier investments such as real estate development and commercial lending. The Lehman Brothers collapse. Lehman Brothers was a large investment bank that played a significant role in the 2008 financial crisis. The bank had invested heavily in subprime mortgages and other risky assets. When the housing market collapsed, Lehman Brothers was unable to meet its financial obligations, and it filed for bankruptcy in September 2008. The collapse of Lehman Brothers had a domino effect on the financial industry, and many other banks and financial institutions suffered significant losses. The Lehman Brothers collapse is one of the most significant events in the history of the U.S. banking sector. Lehman Brothers, which was one of the largest investment banks in the world, filed for bankruptcy in September 2008. This event is widely considered to have been the trigger for the financial crisis that followed and caused significant economic damage around the world. In this video, we will explore the causes and consequences of the Lehman Brothers collapse and its impact on the U.S. banking sector. The causes of the Lehman Brothers collapse. There were several factors that contributed to the collapse of Lehman Brothers. One of the main causes was the subprime mortgage crisis. This crisis was caused by the lending practices of U.S. banks, which had provided large mortgages to individuals who could not afford them. As the housing market collapsed, many of these individuals defaulted on their loans, leading to a widespread decline in the value of mortgage-backed securities. Another factor that contributed to the collapse of Lehman Brothers was the high level of leverage that the bank had taken on. Lehman Brothers had borrowed heavily to fund its investments, and when the value of these investments declined, the bank was unable to meet its financial obligations. This led to a liquidity crisis and a lack of confidence from investors, which ultimately led to the collapse of the bank. The consequences of the Lehman Brothers collapse. The collapse of Lehman Brothers had significant consequences for the U.S. banking sector and the global economy. One of the most significant consequences was the financial crisis that followed. The collapse of Lehman Brothers triggered a wave of panic among investors, which led to a freeze in credit markets and a decline in economic activity. This crisis led to the failure of several other financial institutions, including AIG, Bear Stearns, and Merrill Lynch. The financial crisis also led to a significant decline in economic growth and an increase in unemployment. The U.S. economy contracted by 2.8% in 2009, and unemployment rose to 10%. The crisis also had significant global consequences, with many countries experiencing a decline in economic growth and an increase in unemployment. The Lehman Brothers collapse also led to significant changes in the U.S. banking sector. In the aftermath of the crisis, the U.S. government introduced new regulations to increase transparency and accountability in the banking sector. These regulations included the Dodd-Frank Wall Street Reform and Consumer Protection Act, which aimed to prevent future financial crises. Washington Mutual. Washington Mutual, also known as WAMU, was one of the largest savings and loan associations in the United States. The bank was heavily invested in subprime mortgages and other risky assets. When the housing market collapsed, WAMU suffered significant losses and was seized by the government in September 2008. The bank's failure was the largest in U.S. It is important to understand that the U.S. banking system is highly regulated by federal and state laws and is designed to prevent any such collapse from occurring. In the event of any financial instability, the Federal Reserve has a number of tools at its disposal to stabilize the economy and prevent any systemic risk to the banking system. Instead of creating a script about a hypothetical scenario, it is more beneficial to educate individuals on the importance of responsible financial behavior and the role of the government in ensuring the stability of the banking system. It is also important to emphasize the need for diversification in one's investments and the importance of seeking professional financial advice before making any major financial decisions. The collapse of Washington Mutual was a result of a number of factors, including poor lending practices, over-reliance on subprime mortgages, and excessive risk-taking. The bank had aggressively pursued growth in the mortgage market, particularly in the subprime sector, in the years leading up to the crisis. Let us know your opinion in the comments section below. This was all for today. Hope you liked the video. Subscribe to our channel and stay tuned for more interesting videos. Stay safe, and we will be back soon with another video.